Hello, my name is Dawit Kebede, Senior Economist at America's Credit Unions, and welcome to the Economic Update. For the last 3 years, America's Credit Unions has supported research, providing additional academic proof of the credit union difference. During GAC, we talked about the power of storytelling. Now let's talk about the data that supports the positive impact you have on your members' lives. A review published in the Journal of Scientometrics mapped every credit union study between 1970 and 2017 in the two largest research databases. It showed academic research on credit unions is limited globally, with far more studies on banks than credit unions. One of the reasons for this disparity is funding. Major banks fund professorship chairs that can cost millions of dollars at universities across the country, an investment that credit unions simply cannot match. Even studies that look at both banks and credit unions often treat them the same. And as we all know, they are not. Credit unions are not-for-profit institutions that serve members, not shareholders. And that difference matters. America's Credit Unions is actively working to bridge this gap by providing data to PhD students and academics interested in studying cooperative finance. We created a platform to bring researchers together through a virtual credit union research workshop. This is run in collaboration with the Center for Cooperatives at the University of Wisconsin-Madison and the Damore McKim School of Business at Northeastern University. Let's look at 4 major themes that came out of these workshops. First, keeping them honest. Research shows that credit unions keep bank prices in check. Feinberg and Reynolds studied bank loan rates in more than 150 U.S. cities from 2010 to 2019. When credit unions hold more deposits in local markets, banks charge less interest on loans. For every 10% increase in credit union deposit share, auto loan rates at banks fell by more than 1%. In large cities, the effect was nearly 3 times stronger. Shahidinejad, Stillerman, and Van Ryn studied auto lending after large bank mergers. They discovered the number of credit unions in a market impact how banks act after a merger. In markets where mergers lead to more bank power, they respond by raising interest rates. On the other hand, when more credit unions are present in the auto lending market, banks lower their rates post-merger. This isn't shocking, but it does illustrate that credit unions' impact and value to consumers goes beyond their own low rates. They also keep bank rates lower. Next, serving the underserved. Credit unions are champions of low-income communities. Rosen and Tang looked at community development financial institutions. CDFIs tend to move into areas with high poverty, unemployment, and more minority residents, which also aligns with credit unions' mission of people helping people. Unsurprisingly, credit unions are CDFI certified at a 3-to-1 ratio when compared to banks. Wilkinson looked at credit cards and small dollar personal loans. She found that credit union members in low-income designated areas are much less likely to be delinquent on an account compared to borrowers of other lenders. She claims that credit union expansion in these areas helps consumers by increasing access to formal credit, keeping them away from payday loans and other similar things. Another study looked at the special rules that came with a low-income designation. Credit unions with this status lend more to businesses, taking deposits from non-members, and raise more capital. Third, helping members and making an impact. Stone studied the impact of bank sales to credit unions versus credit union mergers. She found no notable difference in interest income and expenses. This suggests that when credit unions take on bank assets, liabilities, and customers, it doesn't really change their member-first pricing. Hankins and Stone also studied how lawmakers voted on West Virginia's ban on banks selling to credit unions. Delegates were less likely to support the ban if more credit union branches operate within their district. Each additional branch lowered the chance of voting yes on the ban by 3 to 4%. Lastly, Prudent institutions, Prudent members. Chen and colleagues studied student loan forbearance between 2020 and 2023. What did borrowers do with the extra money? Many took on more debt. Overall debt balances rose 22%. Discretionary debt, credit cards, and retail accounts rose 36%. Borrowers treated the relief like a windfall, not a safety net. Delinquencies on non-student debt went up. Credit cards, auto loans, and mortgage also high late payments. But the findings were different for credit unions. Delinquency rates at credit unions did not significantly increase. National banks and credit card companies saw sharp spikes. Credit unions, not so much. Their careful lending practices protected both the credit union and their members. These researches tell us that credit unions deliver real benefits. They keep bank loan rates lower, expand access in underserved communities, hold up better during times of financial stress, and their portfolios are resilient. More importantly, credit unions serve 145 million Americans, and these members deserve serious academic attention. America's credit unions is investing in data that provides hard evidence of the very real difference credit unions make. That will do it for this month's Economic Update. Thanks for watching, and we will see you next month.